Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Joe Cavatoni, market strategist for North America at the World Gold Council, as well as Stephen Schoffstall. He's director of ETF Product Management at Sprott Asset Management. We're here to discuss the key drivers of demand and volatility in the precious metals space. It's great to have the both of you with us. Welcome to Trade Talks. Joe, I feel as if we start the conversation off the same way the past couple times you've been on, where investment demand just continues to surge.
It does, it continues to surge, you're absolutely right. Now, we've had a few things happen over the last 24, 48, call it 72 hours, that has rocked the market a little bit, but the good news is we think we've seen clarity. And what I'm specifically referring to is whether gold in certain formats, 100-ounce bars or kilo bars, is subject to tariff or not. We have an announcement from the president on his social feed saying it is not subject to tariffs, after we had a letter format from the Customs Bureau stating that gold might be subject to the tariffs. So I think we're going to get clarity on that, and leaving all of that noise and that turbulence over the last 72 hours aside, fundamentally what's still driving every amount of interest in gold is that the economic outlook continues to be in question, challenged by the politics mixing into the independence of the Fed, et cetera, and data that's going to come out today. We saw CPI information signaling more likely a Fed cut in September, and we're going to have more of these announcements over the next month into September. Yeah. And it's really at the heart of what's going on.
And Stephen, it's not just gold that's adding volatility to itself. I mean, it's precious metals in general that you're seeing the impact.
Yeah, we see it flow through to the silver markets as well. That's an area that we've been following closely. And if you look at where the investor interest really is, we see investors are really leaning into physical gold exposure through an ETF form. There's about 24 billion or so in assets that have come in so far this year. On the miners, though, we actually see investors are a little hesitant, for the most part, to really step in and take on that equity risk. Even though we've seen miners perform, they're up about 75 to 80% year to date, far outpacing the 27% that we see from gold. When you look at silver, though, that's really been a bright spot. It has both of those elements as a precious metal and industrial metal. It's that industrial metal side of things that's really starting to spur the growth that we see coming to silver. About 60% of all uses now are for industrial purposes, 10,000 uses or more in general, across all aspects of the economy, whether it's artificial intelligence, solar panels, semiconductors, medical uses. We're seeing a lot of interest in the silver space now.
I just learned about that yesterday, that there's over 10,000 applications, and that blew my mind. And coming into this conversation around emerging technologies and the demand that it commands, it's a prime investment case for silver.
It is, and when you look at that demand, it's really starting to mesh with some supply headwinds that we're seeing. If you were to go back and look over the last 6 years, you would see silver's actually been in a supply deficit. We see that over the last number of years also that the new supply coming to market is decreasing by about 4%. So it's struggling to keep up with these new applications. All indications are that 2025, we expect to see another deficit. That'll make 7 years in a row. So at the same time that we need more silver, we're getting less silver to meet that demand. And one of the main issues that we see with that is over 70% of silver is actually mined as a primary metal, or I'm sorry, as a secondary metal. So that means things like copper and zinc are the primary metal. Silver just comes along as a byproduct. So it's anytime you start to see silver prices start to improve, that's not necessarily affecting the underlying economics for the miners. So we could see instances where silver output's decreasing even though prices are increasing.
Joe, I'm going to go back to tariffs for a moment here. What would be the point of adding a tariff onto gold? What's the rationale?
Well, I think what you have to unpack is what exactly is the motivation of tariffs in general. So it's a revenue growth item for the U.S. government, and I think looking at Switzerland, which was the subject of this whole exercise around tariffs, and you look at the trade flows, gold's a material element of what's been moved in and out of the U.S. and Switzerland, and that's why it was hitting the radar in terms of being taxed at a potential 39%.
Right.
But again, the messaging that we had before the election, the messaging we've had since the election, and all the way through to date on gold has that it's not the subject of tariffs. What is the subject of tariffs are critical minerals or other minerals that are used in applications that are industrial in use or defense in use, and gold doesn't fit that mold. And we've had that all the way through. That's been the sentiment, and that's actually what we're getting confirmation on. We're now just waiting for that formal communique to say, correct, what Trump has said in his social feed is exactly how to understand the tariffs. So at the end of the day, what's driving gold right now isn't concern or confusion around tariffs. Even with clarification or concerns, we didn't see the bottom fall out of gold at all. It's still holding very comfortably in its range. Investment, like you've pointed to, that's what's really driving it. Risk assets and offsetting risk assets with a hedge like gold in the US, in China, driving the flows big time in ETFs and in the physical sense. And then don't forget, the central banks continue to be record-setting in their flows. Second quarter was a little slower than we've seen, but still a very substantial number at 160 plus tons coming from global central banks, looking at the dollar, the future of the dollar and the US assets that they hold, and figuring out how to best balance their reserves.
So how do you explain it when you have gold where it's trading, and then you also have major indexes at all-time highs? We just hit a new all-time high in the S&P and Nasdaq 100.
We were just talking about the appetite for risk remains high, and actually what I'm comforted by is the understanding that a cost-effective hedge like gold can be added into your portfolio because it will protect you, as it has during these shocks or the drawdowns or risk moments that actually wobble your portfolio. I'm struggling to understand the risk appetite, but it's there. But what I love to see is the 2 to 5% allocations that we're hearing about going into gold.
What other areas in metals are you taking a look at as the industrial applications in addition to what we discussed with silver?
Yeah, so copper's been a big one ever since there was the presumption that we're going to see 50% across the board tariffs on copper. What that really did was cause a dislocation in the market where we had copper prices in the United States were trading about 30% premium versus what we were seeing in London, which is the primary copper trading benchmark. Fortunately, once those tariffs were announced, the cathodes and the primary material that's traded on the international scale wasn't impacted by those tariffs. So we did see that premium of 30+% collapse down to about 1%. So from that standpoint, there was some expectation that we would see copper start to leave the United States and go back to London and other global trading hubs. We haven't really seen that happen as of yet, so the copper that came in ahead of those expected tariffs are for the most part still staying here. So copper's one we're watching. Another one that's in the news as of yesterday is lithium, is a metal where we've seen that China traditionally has been oversupplying the market in a bid to keep prices lower. It helps keep competition out of the market. There was an announcement that a mine that produces about 6% of global lithium in China was actually not going to have its license renewed. So we saw in response, lithium miners popped about 14% yesterday. The price of lithium, physical lithium, went up about 3%. It's up another 2 or 3% today. So those are a couple developing areas that we're watching, very much tied to electrification and technological advancements.
Right, that's what makes you question, is it necessary to put the level of tariffs in place when there's only so much that can be mined in the US? It's like almost like a codependent relationship with some of the metals and rare earth materials that come out of China.
It is, right? And so there's, over about a dozen and a half different rare earths, right? And they all have different uses. So while we may have access to some here, we don't have plentiful access to all of those. So I think that's some of what these, kind of back and forth that we see with tariff announcements is, as they have a chance to discuss what that actually means for the United States, that's what we're seeing.
I think it's probably one of the most interesting messages that we're getting from Washington, which is the understanding and the actual shift in the political sentiment that critical minerals matter. Actually, maybe not outperforming a China, but leveling the field and ultimately putting a lot of that critical mineral criteria into the negotiations. And to your point earlier, not one thing comes out of the hole in the ground. Right. You have to understand how mining works. It's a really interesting industry, and there's lots of interesting opportunities right now because what's getting mined and how it's getting mined and the changes that are potentially going to take place with the administration signaling that it wants to grow the space, it wants to grow refining, it wants to grow industry. It's all very interesting stuff to keep a very close watch on because again, it's about not necessarily beating someone, it's about leveling the field.
Yeah. And the mining industry is really impacted so much by these tariffs because if you look at how long it takes to get a mine up and running, for copper mines in the United States, it can take close to 3 decades from when you actually find a mine and develop it and get it producing.
Correct.
So you can't just turn the switch and flip production on. And I think that's one of the reasons why we see this back and forth in some of the tariff announcements that we're seeing.
But you need the glide path clear that it's an okay industry to continue to move forward. And I think that's the signal that's coming right now. Find the balance, find the opportunity, move more quickly to get these things online. Right. Now, for us in the gold market, we might be the beneficiaries of seeing more supply coming online or even the production online. Now we're talking with firms that have refining capabilities, and you'll hear people say there's not a lot of that in the US. There's not as much as there could be, or maybe there was in the past, but it's on the minds of a lot of organizations around the country to say, let's bring more capacity to getting this done.
Yeah.
And the appetite's there for it. And actually, to be honest with you, it's looking good that this will continue to develop.
I think the administration, its foresight in terms of wanting to be the leaders in innovation and recognizing that this is a national security issue as well.
Yes.
They're telegraphing that quite clear,
Very
right?
clear.
I mean, we need to be cybersecurity leaders. These components are part of that, right? We want to be leaders in all these emerging technologies, such as AI as an example, right?
Yeah.
We're going to need to think about policy and framework to not take 30 years or 10 years for a grid to come online and be more efficient as it relates to that, because it's the only way we're going to be able to execute on those priorities, Joe.
Absolutely, and one additional element of national security that we've been seeing, and we have a body of work that we're undertaking around artisanal and small scale gold mining, is the fact that that's being a source of funding for the wrong types of organizations, the wrong types of groups, whether it's the Wagner Group or a drug organization that's based in South America. These are bad things happening in the space, and that is on the mind of the US. It's on the mind of national security, border control, as well as understanding how critical minerals fits into that. So this goes beyond just our own borders and our own national security. It goes a bit global, north, south, east, west, and it's definitely a topical discussion right now in Washington.
It certainly is. I mean, Stephen, I see you nodding your head in agreement. When you read in between the lines, you know, in terms of what the tariff strategy is, it's a little bit bigger picture than what's going to happen with the consumer. It's going to be a tax on the consumer and so forth. This is to advance some, you know, heavy strategy and priorities ahead.
Yeah, that's exactly right. We did see, you know, just yesterday, Goldman Sachs came out and said about, you know, 2/3 of the tariffs aren't being borne by U.S. consumers. The expectation is down the road later this year that we'll see that start to filter through the economy. I guess we'll have to wait and see how that pans out. But, you know, back to what you were saying around, you know, different parts of the world and artisanal mining.
Yep.
What is artisanal mining?
So that would be like this very small scale mining where it's, you know, it could be illegal mining or just very much, you know, not the same protections that you would see with tier 1 mining jurisdictions. So when we develop indexes, that we've developed a whole series with Nasdaq, one of the things we do is we don't get exposure to Congo, and also we stay away from mainland China. That's part of the reason for that. Another reason for that is we believe that a lot of the growth is going to shift back to the United States and other Western countries, and we want to, we believe that these, you know, US-based companies are going to benefit from that going down the road. And you know, that seems to kind of gel with what we're seeing out of the administration, out of Congress, as far as they're supporting nuclear energy, they're supporting copper, we're starting to see them support rare earths and other critical materials. So from our standpoint, for the investor, it's an exciting time to get involved in critical materials.
It certainly is. Joe, it looked like you had something to follow up.
I just think in terms of the artisanal and small scale gold mining, this is really what it used to be, was about 4% of gold mine production back about 20 years back. And it was done by people who needed to find a way of living. And now what has happened is it's been mechanized, whether it's by a large country that's funding it, sending in equipment to get it done, or like I mentioned, some nefarious types of organizations that are standing behind it, using it to launder money, fund bad practices, whatever the case may be. And it's grown to about an estimate by the World Bank of about 20%. Now you're also talking a price difference of 400 an ounce to 3,400 an ounce. So you're talking about a significant amount of production coming from this end of the market. And that's why we're focused on saying we need to tackle this issue down, drive out the bad players, and all this work is being done under our programming around gold bar integrity, tracking and tracing, and finding trusted borrowers like central banks that will put their left hand looking for gold in their reserve portfolio out to serve the hand of the right to buy it from home. So they're looking at like markets like the Philippines, where they are buying gold from the home front, provided certain criteria are met in terms of the production quality, the humanitarian efforts with the staff and so forth, and they're doing it all above board. So it's a really interesting topic.
I wonder if consumers are fully aware of that. We know with blood diamonds and how that is you know, transformed the way that, you know, diamonds are purchased these days, and recyclable gold and, you know, sustainability movement and so forth is important, but you said it grew by almost 20%?
Production is estimated that level. It's very hard for us to get a good, complete number on it, but that's the best estimate we have.
Speaking of the consumer, what about jewelry demand? How's that doing relative to this conversation?
As expected. So we're at prices that are at record highs. We keep touching these record highs. As a consumable good, it's typical that you would expect it to slow down quite dramatically. The biggest markets, China, India, second quarter data showed big slowdown in both of those markets. The same in the US, the same in Europe. we're not going to see that market turn until we either have a big price correction, which we don't expect,
Right.
or you have the jewelry market evolve its ways to get smaller and more affordable pieces back into the consumer.
Yeah.
Or the consumer feels good.
But that's a smaller piece
It's
of the investment case for gold.
It's a big component of
Right.
demand for gold on an annual basis, and it continues to be a big component. But what's driving right now the price for gold? Investment pure and central bank demand. And actually, interestingly, when you look at the big jewelry markets, China and India, the growth of investment in those two markets, record setting. ETFs, physical forms of gold, other product offerings, and they really, really understand how gold fits into an investment portfolio.
Oh, I'm sorry.
I was going to say the central bank buying,
I was just gonna ask you
if
this.
you look at the last 3 years, this is one difference between gold and silver. Silver doesn't have that central bank buying that we see with gold. So over the last 3 years, over 1,000 tons per annum was bought by central banks. It's about double what we were seeing throughout the 2010s. So a lot of that comes around this whole geopolitical upheaval that we see in the tensions going on, whether it's trade related or militarily. Companies or countries realize that their assets can be sanctioned, and one way to kind of take hold of their assets is to store it in gold. They can repatriate that back and get that outside of the United States or European Union's reach as it relates to sanctions.
So speaking of central banks, if there is a shift in Fed policy, is that going to impact demand? Or is it 25 basis points, 50 basis points really going to move the needle?
Yeah, so usually what we see, silver is a great example of what happens when we start to see rate cuts. If you look at the last 3 regimes of rate cuts, starting with the dot-com burst, the global financial crisis, and then back in 2019. 2019, we saw silver rally about 143%. After the dot-com bubble and global financial crisis, as well in excess of 400%. So silver in particular tends to do very well when we see these periods of debasement. Both gold and silver, given their monetary aspects, tend to do well anytime you start to see high geopolitical tensions, decreasing interest rates, higher inflation, or currency debasement.
Right.
So Joe, you would expect the same for gold?
For gold, we're looking to see 2 things develop. With rate cuts, we will actually see an increased level of interest, particularly by the U.S. investment community, to add gold to their portfolio. The cost of owning gold becomes much more affordable in terms of adding it to your portfolio, and it also continues to be fueled by that need for risk offset, which will start to get a little bit more interesting when we start to see the Fed taking action to deal with the economic landing that we're expecting. As it relates to the central banks, absolutely geopolitical risks and others. But when you dig into the survey report that we put out, this is our 8th year with about 72 different central banks, you're going to find that they're looking for a liquid instrument that actually holds its value, that they can use to protect themselves for homegrown inflation and concerns, as well as diversification away from fiat currencies, which are losing their value. And that's what's happening when you're looking at what's going on, not only with the US dollar, but the euro. Gold's well publicized now to be a larger holding in reserve portfolios than the euro is at this stage.
Yeah, and I think there's a lot that goes into, particularly for retail investors and smaller scale investors in the United States. When you look at how gold's performed, there's this, people tend to say it doesn't have a yield. They tend to think that underperforms the market. Going back to the turn of the century, gold's actually up about 10% per annum. S&P is up less than 8%. So it actually does quite well over longer periods. And to your point, adding that durable position to your portfolio, whether it's 3%, 5%, what have you, can help improve investor outcomes while providing diversification, because it does have low to moderate correlation to many asset classes, negative correlation to the US dollar. So if a declining dollar is something that investors are concerned with, gold can potentially help offset that somewhat.
All right, appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.